Okay, so let's start. We want to continue from where we left. Let's now continue from where we left. We are to start with the topic. We are to start with the topic called external reconstruction. That's what we want to start with. So let's start. External reconstruction. That's what we want to start with. Just a minute. Okay. So we want to do this topic. We are finished. Listen, we are finished with the topic of internal reconstruction. So we want to do external reconstruction. We want to do now external reconstruction. Now, so let me introduce it first. Don't write anything. Let me introduce it first. Suppose you are a company called A, which is being reconstructed through external reconstruction, through what we call external reconstruction. I told you when I was introducing the topic that if you are reconstructing a company through external reconstruction, I said this company being reconstructed will have to sell their business to another company. Let's call it company B. This company B, we said, could be another existing company, or we said it could be an existing company, or we said it can be a newly formed company. You can form a company so as to take over the business of the company being reorganized. So we are saying in an external reconstruction, company A will sell their business to another company, let's call it company B, which could be another existing company, or it could be a newly formed company. Now, whenever a company is reconstructed through external reconstruction, we normally say that company must be liquidated. That company should be liquidated so that they sell their business to this new company which is buying. Company A, they are selling their business to company B. So company A must liquidate themselves so that they sell their business to company B. We normally refer to company A as the selling company, and we shall be referring to company B as the purchasing company. We shall be referring to company B as the purchasing company. So in an external reconstruction, listen to this now. In an external reconstruction, a company is liquidated and it sells its business to another existing company or a newly formed company. So that's how, or that's what external reconstruction is. That a company is liquidated so that they can sell their business to another existing company or a newly formed company. We have said company A must liquidate themselves. Listen, in the process of liquidating themselves, listen, company A will have to close their books. Company A will have to close their books, while company B will be required to open their books. Remember, company B is the one buying A. So B will open their books while company A will close their books, while company A will have to close their books. So in any question the examiner will test you on external reconstruction, he will always ask you to show the accounting entries in the books of the selling company, that is to close their books. He will also ask you to show the accounting entries in the books of the purchasing company so that they open their books, Good. Now, before we continue, let me mention something for the new students, because again, today is a free class. So let me mention something. Today being a free class, let me mention something for the new students. Listen to this. Sometimes you may be disconnected because of your Wi-Fi strength being weak, especially when you're watching a live video. Listen to the new students, today being a free class. Anytime you are disconnected because of your Wi-Fi being weak, if you click on the disconnected video and you realize it's not bringing you back to class, then there are two other ways in which you can come back to class. I'm talking to the new students that in case you are disconnected because of your Wi-Fi strength being weak, how can I come back to class? If you try and click on the disconnected video and it doesn't bring you back to class, then I'm saying there are two ways of coming back to class. One, you can refresh your page. The page on which you're watching the video from, you can refresh that page. Normally, on the top left or on the top right of your page, there is always a refresh button, which normally appears something like this. A refresh button, which normally appears that way. If you have it in your gadget, then you can click it to refresh the page. That will bring you back to class. Alternatively, if your gadget doesn't have the refresh button, then you can go back to the group where the link was posted and you click on the link again. That means you join the class again. You join the class again. Those are two ways in which you are disconnected, and especially if you are watching a live video. For the recorded ones, normally they have no issues, but when you're watching the live ones, sometimes it has issues. When you click on the disconnected video and it doesn't take you back to class, you refresh the page if your page has a refresh button. If that does not bring you back, or if you don't have it, then go back to the group, click on the link that was sent to the group. Now listen again. This is now to everybody. This is now to everybody. I am appealing to you to subscribe. I'm appealing to you to subscribe to my YouTube channel so that you can get notification of the future videos in case we post them in our YouTube channel. So please subscribe. You can even do that as you're watching this video. Just click on the subscription button down there, and you can even click the notification bell. You can even click on the notification bell so that you are notified whenever we are posting new videos. So please subscribe to my YouTube channel. Even as you're watching now, you can subscribe. Click on that subscription button down there. Good. Now, so let's continue. So I've finished the things outside the topic. So let me continue. I was saying, in an external reconstruction, a company is liquidated and they sell their business to a newly formed company or to another existing company. I've said the company that is selling their business, we shall be referring to it as the selling company. The company that is buying A, we shall be referring to it as the purchasing company. Company A will have to close their books. When they're dealing with the accounting entries, they close because they have to liquidate. They close their books, while company B will have to open their books. So before we look at the accounting entries, let's put down something now. Before we look at the accounting entries, for each of them, let's put down what we have just said. So the topic is, the topic is external reconstruction. External reconstruction. The topic is external reconstruction. Then you say this, external reconstruction. Then you say this takes place, that is external reconstruction. Then you say this takes place when a company is liquidated. This takes place when a company is liquidated and sells its business, when a company is liquidated and sells its business to another existing company, and sells its business to another existing company or a newly formed company. I've said this takes place when a company is liquidated and sells its business to another existing company or a newly formed company. Good. So allow me now to go through the accounting entries in the books of the selling company. I've told you company A will have to sell their business to company B, so they must close their books. So allow me to go through the accounting entries. So we are going to discuss what are the accounting entries in the books of the selling company. What are the accounting entries in the books of the selling company? So let me go through them first. Number one, you as company A, you may have some assets which company B wants to take over from you. So number one entry is, you as company A, you will have to close all assets taken over by the purchasing company at their book values. Close all assets taken over by the purchasing company at their book values to an account we shall be calling realization account. So let me open it somewhere here. So we shall have this account called realization account. So I've said, close all assets taken over. The question will tell you which assets were taken over by company B. So you A, you close them at their book values to the realization account. We know assets are always a debit balance, and therefore to close them, you will have to credit the asset and you debit realization. So that's our entry number one, that says with assets taken over, or close all assets taken over at their book value. The key word there is book value. Very important. Close all assets taken over at their book values to the realization account. How? By crediting the asset and debiting. You credit the asset and you debit realization. Good. That's number one. Number two, some of your liabilities, you company A, may be taken over by company B. So number two says, with liabilities taken over again, could be company B decides they are going to take over your creditors. Company B decides they are going to take over your bank overdraft and maybe your bank loans. So what do you do as company A? Close those liabilities that have been taken over from you again to where? To the realization account. So our entry number two is, with liabilities taken over, you debit the liability. You know, liabilities are always a credit balance, and therefore to close them, you will have to debit those liabilities and you credit realization. That's number two. So it means, therefore, I hope you're listen, in the books of the selling company, the operating account is this account we are calling the realization account. That's our operating account. So I'm through with number two, which says, with liabilities taken over, you debit liabilities, you credit realization. You debit liabilities, you credit realization. That's number 2. Number 3, Company A is selling their business to Company B. Listen, Company A is selling their business to Company B. You, Company A, because you are selling your business to Company B, it is obvious you are charging Company B something to buy you. What is it that you are charging them to buy you? Whatever you are charging Company B to buy you, that is what we normally refer to as the purchase consideration. So number 3 entry says, with the purchase consideration, whatever it is, how much is you, Company A, charging Company B to buy you? Let us assume for purpose of illustration that we as Company A, we are charging Company B 50 million shillings to buy us. We are charging them. I have not said, listen, I have not said B has paid us. I am charging them. Meaning, as Company A, I am creating a data. At this point, I am creating a data by the name of Company B. I want to charge them 50 million. They will pay me later. That's our entry number 3, which says, with the purchase consideration, you will debit, listen, you will debit the purchasing company, whatever the name of the purchasing company, which for now, we want to assume is Company B. With that purchasing company, we want to assume it's 50 million. You will debit the purchasing company by that 50 million, and you will credit realization. And you will credit realization. That is our entry number 3. With the purchase consideration, whatever it is, you debit the purchasing company. Listen, I've told you, by me debiting the purchasing company, I'm creating a data. This is a data. Now it's a data. He will pay me later. Good. That's our entry number 3. Number 4. Company A, we have said, must be liquidated. They must liquidate themselves. In the process of liquidating themselves, they may incur some expenses to liquidate themselves. And that's what we call liquidation expenses. So they may be forced to incur some liquidation expenses. So if you incurred liquidation expenses, you as Company A, listen, if you paid it on your own, you paid for that liquidation expense, maybe it was 2 million shillings, and you paid for that liquidation expense on your own as Company A, then you will debit realization, and you will credit bank. You will debit realization and you will credit bank with that amount we are calling liquidation expenses, whatever it is. There are times when, listen, there are times when the question tells you, Company A, yes, they are selling their business to Company B, but Company A does not have that 2 million that they need for them to liquidate themselves. Remember, I have told you, it is their responsibility for them to liquidate themselves so that they can sell their business to Company B. So in the process of trying to liquidate themselves, they realize they need 2 million. But maybe they don't have that 2 million. But you, Company B, because you want to buy Company A, you decide, you B, listen, you decide you will pay for them their 2 million. You will pay for them the 2 million on their behalf. So, listen, it is not a cost of B. It is a cost of A. It is your responsibility as Company A to liquidate yourself. But you don't have the money to liquidate yourself, so B pays it on your behalf. So we normally say that you as Company A, you have incurred but not paid. You have incurred that liquidation expense, but you have not paid. So if you incurred but not paid, in other words, if it was paid by B, what should be your entry in your books, you as A Limited? In case it is incurred but not paid, you will still debit realization. You will still debit realization and you will credit, listen, you will credit an account we shall be calling provision for liquidation expense. Provision for liquidation expenses. Meaning you create that liability. It's a liability you are incurring. Once company B gives you the 2 million later, you will now pay this liability. So you have incurred but not paid. So you create a liability to be paid later. You create a liability now to be paid later. So in that case, I've said, for number 4, I've said this. With the liquidation expenses, if paid by the selling company, debit realization, I've said, you credit bank. Then I've gone further and said, if incurred but not paid, you still debit realization and you credit the account called provision for liquidation. So that once B gives you the 2 million, later you will now pay by debiting this liability and crediting bank once you receive the 2 million from them. That's our entry number 4. That's our entry number 4, which says with the liquidation expenses. Let me go to number 5. Number 5. For number 5, I want to take you back to number 1. For number 5, I want to take you back to number 1. Number 1, we have said, close all assets taken. Close all assets taken over. What if you, company A, you have some assets which company B does not want to take over them from you? As company A, you have some assets which B does not want to take over from you. And remember, company A must be liquidated. And when a company is liquidated, listen, you cannot leave some accounts pending. So what do you do with such assets? You as company A, you will have to get somebody to sell them to. So our entry number 5 says, with any assets not taken over but sold, with any assets not taken over by the purchasing company but sold by the selling company, obvious, you are the one selling the asset. You will debit bank and you will credit the asset. Whichever the asset you are selling, let us assume it's a motor vehicle. For now, you are told that motor vehicle, let me assume so, that motor vehicle maybe had a book value of maybe 2 million. Then the question tells you it was sold for 1.5 million. So you will debit bank and you will credit the asset. You come and say your bank, 1.5 million, 1.5 million. Of course, you can't leave this account that way because you have sold the asset. So there is that gain or that loss on disposal, and whatever is the gain or loss on disposal, you will take it to the realization account. Listen, I have not said take it to the P&L account. We are not operating a normal business. We are reconstructing. So you don't take the gain or loss to the P&L account like we normally do in a normal business. Our operating account, I've told you, is the realization account. So that's where you take any gain or loss in the process of reconstructing the company. So with this case, it looks like a loss of 500. I'm going to credit motor vehicle and debit realization. If you sold it for 2.5, when the book value was 2 million, then you made a gain. You will debit the motor vehicle by 500 and you will credit realization. So that's our entry number 5, which says, with any assets not taken over by the purchasing company, but sold by the selling company, debit bank, credit asset. Then I've said with the balance in the asset account being either gain or loss on disposal, you transfer it to the realization account. That's number 5. Number 6. For number 6, I want to take you back again to number 2. So number 5 was going by number 1. Number 6, I want to take you now to number 2. Number 2, I told you, with the liabilities taken over by the purchasing company. I told you, you debit the liability to close it, you credit realization. But what if again, company B, for example, did not want to take over your creditors? You are company A, but B does not want to take over your creditors or your loan. What do? And yet you must liquidate yourself, and you can't leave any account pending. So you may decide, because company B does not want to take over our creditors, we shall pay it on our own. So number 6 says, with the liabilities not taken over, but paid. With the liabilities not taken over by the purchasing company, but paid by the selling company, we are saying you debit liability. You are paying that liability. Let us assume it's creditors. Let us assume it's the creditors. You go to the book, you find the creditors are worth maybe 2 million. Then the question tells you, these creditors were willing to accept. They were willing to accept 1.8 million in full. 1.8 million in full settlement of the debt. So you debited creditors and credited bank 1.8. The creditors were willing to accept 1.8 million in full settlement. So you debit creditors and you credit bank. But again, you can't leave the account this way. For this, I hope you can see, the creditors must have given us a discount. We owe them 2 million. They are willing to accept 1.8 million in full. That automatically means they are giving us a discount of 200,000. With that discount, you will debit creditors by 200,000 and you will credit what? Realization. You will credit realization. That's our entry number 6, which says, with the liabilities not taken over by the purchasing company, but paid by the selling company, you will debit liability, whichever it is, and you will credit bank. Then we are going on to say, if there is any discount received from creditors, you will debit creditors and credit realization. That's our entry number 6. 7. I've told you that company A must be liquidated. And you know that when a company is liquidated, normally the stakeholders of the company, they are paid what is due to them. The stakeholders include ordinary shareholders, debenture holders, preference shareholders, and so on. Listen to this now. So, because they must be paid, let's take, for example, ordinary shareholders. As a company, there are so many things. That we owe to the ordinary shareholders. One of them being their ordinary share capital. 2, you also owe them any reserves, be it share premium, be it general reserve, be it revaluation reserve. Whatever reserves are there in your company, they normally belong to the shareholders, called ordinary. Now, because there are so many things, because there are so many things belonging to the ordinary shareholders, you can't pay them those things through those individual accounts. For example, you can't pay them their ordinary through ordinary share capital. You can't pay them their share premium through share premium. You can't pay them their revaluation reserve through revaluation reserve. You can't pay them their general reserve through general reserve. No. Listen, what do? As a company A, listen, you create a liability account for the ordinary shareholders so that everything that you owe to them, you transfer it to that account. So that later, you will only pay them once as a lump sum. Instead of paying them in piecemeal, now you will pay them at once. So we want to open that account that is for the ordinary shareholders. So our step number 7 says, you transfer the balance of the ordinary share capital. Transfer the balance of the ordinary share capital, because that's the first thing you owe to them. Transfer the balance of the ordinary share capital to an account we shall be calling, let's put it that way, to an account we shall be calling ordinary shareholders members account. We create a liability by the name of ordinary shareholders members account. Some books will call it ordinary shareholders sundries members account, but in general we are just calling it ordinary shareholders members account. This is a liability account that will take everything that belongs to the ordinary shareholders, then finally we shall pay them through this account as one amount. So step number 7 says, transfer the balance of the ordinary share capital. Transfer the balance of the ordinary share capital to the ordinary shareholders members account. You debit ordinary share capital, or you know share capital is always a credit balance. To close it, you debit share capital and you credit ordinary shareholders members, and you come and say ordinary share capital, whatever it is. That's our entry number 7, which says transfer the balance of the ordinary share capital to the ordinary shareholders members account. We go to number 8. Is that the only thing that belongs to the ordinary shareholders? The answer is no. What else? We have reserves. So step number 8 says, transfer reserves. Again, to where? To the ordinary shareholders members. Listen, these reserves could be positive reserves or negative reserves. Our reserves could be a negative reserve or a positive reserve. Positive reserves like share premium, general reserves, revaluation reserves, those are positive reserves. It could be a negative reserve like retained losses. Retained losses is still a reserve, but it's a negative reserve. But whichever reserve, we are saying it belongs to ordinary shareholders. Transfer it accordingly. So we are saying under number 8, if the reserve is a positive reserve, if it's a positive reserve like share premium is always a credit balance. You will debit that share premium to close it. You will debit that share premium to close it, and you will credit. And you will credit ordinary shareholders members account. And you come and see a share premium. Or it could be general reserves. It could be revaluation reserve, whichever positive reserve that you have, whatever positive reserve that you have. Good. If we are still going on, if it is a negative reserve, which of course will be there in any question. Why? Because I told you the purpose of reconstructing a company was what? When I was introducing the topic, we said last time, the purpose of reconstructing a company is to help the company to eliminate the accumulated losses. So this company that we are reconstructing, it is obvious it must have been making losses. And that's why we are reconstructing it. So in any question of reconstruction, the company will always be making a loss. And that's what we are calling a negative reserve. So if you go to the P&L account of this company A, you will find their P&L account having a debit balance. Losses are always a debit balance, and therefore to close them, you will credit that P&L, you will credit the P&L and debit ordinary shareholders members. In other words, give them their share of loss. That's what we are saying. That's our entry number 8, which says transfer reserves to the ordinary shareholders members. I've said number A, if positive reserve, you debit that reserve, be it share premium, general reserve, revaluation, and you credit ordinary shareholders members. Then I've said if negative reserve, of course, like the retained losses, I've said you debit ordinary shareholders members and you credit P&L account and you credit P&L account. Let me go to number 9. For number 9, I want you to listen now. For number 9, I want to take you back to number 1 and number 5. For number 9, I want to take you back to number 1 and number 5. Number 1, I told you, close all assets taken over. Number 5, I told you, with any assets not taken over but sold. Now listen. It could happen that company A has an asset which could not be taken over by company B in step 1, and which company A itself could not find a buyer to sell to under number 5. As a company A, you have an asset which could not be taken over by company B. B does not want to take it over, and you, A, you couldn't get somebody to sell it to. Yet we have said company A must liquidate itself and all accounts must be closed. You cannot liquidate a company and leave it with some pending accounts. No. So what do you do with such an account or such an asset? We normally refer to such an asset as fictitious assets. We normally refer to them as fictitious assets. For example, you company A, you may have in your balance sheet an asset called goodwill. B does not want to take over your goodwill. You, A, you can't get somebody to sell to your goodwill. Or you have an asset called copyright, trademarks, and patents, for example. And mostly this happens for the intangible assets. This normally happens for intangible assets, where you couldn't give them to company B, and also you as A, you couldn't get somebody to sell them to. So the question is this. Now listen. Who takes over the loss of such an asset? Who takes over the loss of such an asset? The person who takes over the loss of such an asset is the owner of the company. And who is the owner of the company? The ordinary shareholders. So step number 9 says you transfer again the fictitious assets to where? To the ordinary shareholders members. Give them the loss of such an asset. Let them take over the loss of such an asset. So we are saying with any fictitious assets, e.g. copyrights, trademarks, goodwill, and any other, let the owners take over the loss of such an asset by debiting what? By debiting the ordinary shareholders members. Give them the loss. You come here and you debit the ordinary shareholders members with that amount of the fictitious assets, and you credit the asset because an asset is always a debit balance. To close it, you credit and you debit the ordinary shareholders' members. Now listen. Before we put down the notes on those accounting entries, I hope you have noted this. Listen carefully. I hope you have noted this. That our entry number 7, 8, and 9. Our entry number 7, 8, and 9, they are related in the sense that it is anything that belongs to the ordinary shareholders that we have dealt with in step 7, 8, and 9. So that's all that belongs to who? To the ordinary shareholders. Now listen carefully. What if these are not the only stakeholders in your company? Maybe you have preference shareholders also. So the way you have done for ordinary, now you will also be required to do for preference. Again, listen. There are many things that you owe to the preference shareholders, but you can't pay them what you owe to them through the individual accounts. For example, you owe the preference shareholders for their share capital. Another thing you could be owing for them is maybe preference dividends that are in arrears. If you have not paid your dividends in arrears for the last 2 years, you will be required to pay them. So that's another amount that you owe to the preference shareholders. So we now come to step number 10. We now come to step number 10, where now we want to deal with preference shareholders. Listen, the way I opened an account for the ordinary shareholders, where I took everything that belongs to them to that account, I do the same for the preference. In other words, I open a liability account for them. For them, again, it will be called preference shareholders members account. So step number 10 says we transfer the balance. We transfer the balance of the preference share capital. We transfer the balance of the preference share capital to the preference shareholders members account. We transfer the balance of the preference share capital to the preference shareholders members account. So you open another liability account for them by debiting preference share capital, and you credit preference shareholders members. This is preference shareholders members. It's a liability for them. Close that preference share capital by debiting preference share capital, and you credit preference shareholders members, and you come and say a preference share capital, whatever it is. That's number 10. Listen, still under number 10, we want to come back and say, what if there were any preference dividends in arrears? With any preference dividends in arrears, listen, I want to remind you, when we were discussing internal reconstruction, we saw that as a company also, when we were reconstructing a company through internal reconstruction, we saw that a company could also have preference dividends in arrears. And I remember telling you, when you have preference dividends in arrears, if you go to the balance sheet of the company, you will not see that amount as a liability. No. We said preference dividends in arrears don't appear in the books as a liability. I hope you still remember. We said they are an example of a contingent liability. I hope you remember. We said an example of a contingent liability was preference dividends in arrears. Listen. And so when we were doing internal reconstruction, we said, in the process of reconstructing a company, when you realize that the company has a contingent liability. We said, what do you do in the reconstruction? We said you crystallize that liability. In other words, we said you make it as a liability. So when we were discussing internal reconstruction, we had to crystallize it by debiting which account? We were debiting the account called capital reduction account, and we were crediting preference dividends in arrears, or if they don't give you the name, we said you just credit contingent liability. So that's how we were crystallizing in the area of internal reconstruction. You had to crystallize, yani make it a liability by debiting capital reduction and crediting contingent liability. Then I was telling you that time, if the examiner gives you the name of your liability, like now we know it's preference dividends in arrears, you debit capital reduction, and we said you credit preference dividends in arrears. Listen, the same thing for external reconstruction. Now that we are reconstructing a company through external reconstruction. So the same thing, preference dividends in arrears don't appear in the books. But we are constructing the company. So because they are amounts that we owe to the preference shareholders, we must crystallize them again. In other words, we must make them a liability. They are not in the balance sheet. To make it a liability, we debit realization. I told you our operating account, when it comes to external reconstruction, is realization. So with any contingent liability like preference dividends in arrears, I've said you now debit realization and you credit. With any preference dividends in arrears, you debit realization and you credit the preference shareholders members. Now you have a liability for them. Now you don't open a contingent liability account, no. Remember, it's an amount that we owe to the preference and we have already opened a liability for them. So you just come to that liability and you increase it. This is because of any preference dividends that are in arrears. Good. So that's our entry number 10, which says transfer the balance of the preference share capital to the preference shareholders members account. I have to debit preference share capital. I have to credit preference shareholders members. Then I've gone further and said, if there are any preference dividends that are in arrears, we have said you debit realization and you credit preference shareholders members account to increase what you owe to them. Now listen, when it comes to the books of the selling company, there are 15 accounting entries. So far we have discussed 10. So before we discuss the remaining 5, let us put down those first 10. Let's put down those one first. Let's put down these 10 before we continue and do the remaining 5. So let's go back. Let's go back. So have another subtopic now. Have a subtopic now. That's what we are discussing now. Okay. So andika, I hope you are writing. Umeandika the subtopic, entries in the books of the selling company. I hope you have written the subtopic, entries in the books of the selling company. Entries in the books of the selling company. Entries in the books of the selling company. Okay, so let's put down those entries now. Let's put them down. Number 1, sema hivi. Number 1, close all assets taken over. Close all assets taken over by the purchasing company close all assets taken over by the purchasing company, close all assets taken over by the purchasing company at their book values. Close all assets taken over by the purchasing company at their book values. 2. Close all assets taken over by the purchasing company at their book values to the realization account. Close all assets taken over by the purchasing company at their book values to the realization account. So put down the double entry, debit, realization, credit assets. Debit, realization, credit assets. Debit, realization, credit assets. That's number 1. Number 2. Number 2, with liabilities taken over. With liabilities taken over by the purchasing company. With liabilities taken over by the purchasing company. Debit, liabilities, credit, realization. Debit, liabilities, credit, realization. Debit, liabilities, credit, realization. Okay, that's number 2. Number 3. Number 3. With the purchase consideration. With the purchase consideration. With the purchase consideration. Debit. Purchasing company. Debit, purchasing company. Put in bracket data. I told you they will pay us later. But for now, we are just creating a data. Debit, the purchasing company. Credit, realization. Debit, purchasing company. Credit, realization. That's our number 3. Number 4. Number 4. Number 4. With liquidation expenses. Number 4. With liquidation expenses. With liquidation expenses. Under that, andika A. With liquidation expenses, andika number A. If paid by the selling company. If paid by the selling company. Debit, realization, credit bank. If paid by the selling company. Debit, realization, credit bank. Number B under that. Number B under that. Number B under that. Sema hivi. If incurred but not paid. If incurred but not paid. If incurred but not paid. Debit, realization. If incurred but not paid. Debit, realization. Credit, provision for liquidation expenses. Debit, realization. Credit, provision for liquidation expenses. Okay? That's number 4. We have said number B, if incurred but not paid. Debit, realization. Credit, provision for liquidation expenses. Number 5. Number 5. Number 5. With any assets. Number 5. With any assets not taken over. With any assets not taken over. With any assets not taken over by the purchasing company. With any assets not taken over by the purchasing company, but sold by the selling company. With any assets not taken over by the purchasing company, but sold by the selling company. Debit, bank, credit, asset. Debit, bank, credit, asset. Debit, bank, credit, asset. Then under that, andika NB, debit, bank, credit, asset. Then you say NB, NB, with the balance in the asset account. With the balance in the asset account. With the balance in the asset account being either a gain or loss on disposal. With the balance in the asset account being either a gain or loss on disposal, comma, transferred to the realization account. Being either a gain or loss on disposal, transferred to the realization account. Okay, that's number 5. Number 6. Number 6. Number 6. With any liabilities not taken over. Number 6. With any liabilities not taken over by the purchasing company. With any liabilities not taken over by the purchasing company. With any liabilities not taken over by the purchasing company, but paid by the selling company. With any liabilities not taken over by the purchasing company, but paid by the selling company. Debit, liabilities, debit, liabilities, credit, bank. Debit, liabilities, credit, bank. Debit, liabilities, credit, bank. Then below that, under number 6, NB, note. Under that, note. Under that, note. With any discount received from creditors. With any discount received from creditors. With any discount received from creditors. Debits, creditors, credit realization. Debit, creditors, credit realization. Debit, creditors, credit realization. That is number 6. Number 7. Number 7. Number 7. I hope you are through with number 6. Number 7. Transfer the balance. Number 7. Transfer the balance of the ordinary share capital. Transfer the balance of the ordinary share capital. Transfer the balance of the ordinary share capital to the ordinary shareholders members account. Transfer the balance of the ordinary share capital. Transfer the balance of the ordinary share capital to the ordinary shareholders members account. Transfer the balance of the ordinary share capital to the ordinary shareholders members account. Debit, ordinary share capital. Debit, ordinary share capital. Credit, ordinary shareholders members account. Debit, ordinary share capital. Credit, ordinary shareholders members account. That's number 7. Number 8. Number 8. Number 8. Transfer reserves. Transfer reserves to transfer reserves to the ordinary shareholders members account. Transfer reserves to the ordinary shareholders members account. Transfer reserves to the ordinary shareholders members account. Under that, number A, if positive reserve, e.g. share premium, if positive reserve, e.g. share premium, debit, share premium, credit, ordinary shareholders members. Debit, share premium, credit, ordinary shareholders members. Still under number 8, andika B. B, if negative reserve, e.g. retained losses, if negative reserve, e.g. retained losses, debit, ordinary shareholders members, credit, profit and loss account. Debit, ordinary shareholders members, credit, profit and loss account. Okay, so you're giving them their share of loss. That's where you're charging the ordinary shareholders members. That's number 8. We go to number 9. Number 9. Number 9. Sema hivi. Transfer the balance. Okay. Yeah, transfer the balance of any fictitious assets. Transfer the balance of any fictitious assets to the ordinary shareholders members account. Transfer the balance of any fictitious assets to the ordinary shareholders members account. Transfer the balance of any fictitious assets to the ordinary shareholders members account. Debit ordinary shareholders members. Debit ordinary shareholders members. Credit fictitious assets. Debit ordinary shareholders members. Credit fictitious assets. Good. That's number 9. Number 10. Number 10. Sorry, this is fictitious assets. So complete it, call it fictitious assets. Then you come to number 10. Number 10. Transfer the balance. Transfer the balance of the ordinary share capital. Sorry. Transfer the balance of the preference share capital. Transfer the balance of the preference share capital. Transfer the balance of the preference share capital to transfer the balance of the preference share capital to the preference shareholders members. Transfer the balance of the preference share capital to the preference shareholders members. Debit preference share capital. Debit preference share capital, and you credit preference shareholders members. Debit preference share capital, credit preference shareholders members. Okay. Still under number 10. Still under number 10, andika NB. Still under number 10, andika NB. NB. With any preference dividends in arrears. 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 Debit realization. Credit preference shareholders members. Debit preference debit realization. Credit preference shareholders members. It's something that you owe to them, and so we said you have to increase what you owe to the preference shareholders. Good. That's number 10. So let's go back and complete the other 5 more entries in the books of the selling. Let's now go back and try and complete the other 5 entries in the books of the selling company now. Okay? So finish. For those who are still copying, I want to go to number 11, 12, 13, 14, and 15. Okay, so I want to go back to the entries, the accounts that I was using so that I move with you now. I hope you're through with the copying. Sawa. So let me take you back. Where were we? We are here. We are now at number 11. Now, listen. Listen to number 11 now. Listen to number 11. For number 11, listen carefully. I want to take you back to number 3. For number 11, I want to take you back to number 3. What was number 3 about? If you check, we said number 3, with the purchase consideration. I told you that time. We were assuming that we are charging company B 50 million. And so we had to debit B as a data. You remember, here it is, where we said with the purchase consideration, we said you debit the purchasing company now. I hope you can see it here. You debit the purchasing company, and we said you credit realization. Now listen carefully. A time has come for company B to pay us that 50 million. A time has come them to pay us that 50 million. Listen, company B can decide they are going to pay you all that 50 million in cash, or they may decide they are going to pay you as company A all that 50 million by giving you their shares, or they may decide they are going to pay you all that 50 million by issuing to you their debentures. Alternatively, they may decide part of that 50 they are going to pay you in terms of cash, part of it in terms of shares, and part of it maybe in terms of debentures. So let us assume for purpose of illustration that as company A, as B, you decided you are going to pay 10 million of that amount in cash, 20 million in terms of shares, and another 20 million in terms of debentures. So B is paying you. You are now A. You are the one receiving these payments. So you are receiving them from a data. Just like you can receive cash, you are receiving also shares, you are receiving debentures. So our number 11 says, listen now, our number 11 says, with the receipt of the purchase consideration, with the receipt of the purchase consideration, either in form of cash, shares, or debentures. If you are being paid in terms of cash, you will debit cash, that 10 million, you will credit the purchasing company 10 million. If you are being paid in terms of shares, you will debit shares account. Remember, you are receiving them. So to you, listen, they are assets. You are not issuing shares. You are not the company issuing. B is the one issuing. You, A, you are receiving. So you are receiving them as an asset. So you will debit shares of B Limited by 20 million. You will credit the purchasing company, and you come and say, yes, shares, 20 million. You are receiving debentures also, worth 20 million. You are receiving, not issuing debentures. The other company is the one issuing. You are receiving. So you are receiving it as an asset. You will debit debentures, whatever it is, by 20 million, and you'll credit the purchasing company by 20 million. So our step number 11 says, number 11 says, with the receipt of the purchase consideration, either in form of cash, shares, or debentures, you will debit cash, debit shares, debit debentures, and you credit the purchasing company. And you credit the purchasing company. Good. So let's put down that number 11. Let's put down that entry number 11. So let's go back to our entries now. We put down number 11. We put down number 11. And the KV, number 11. With the receipt of the purchase consideration. With the receipt of the purchase consideration. With the receipt of the purchase consideration. Either in form of, with the receipt of the purchase consideration, either in form of cash, shares, or debentures. With the receipt of the purchase consideration, either in form of cash, comma, shares or debentures, then put down debit cash, stroke, shares, stroke, debentures, and you credit purchasing company. And you credit the purchasing company. Now you can put in bracket data. You are also receiving from your data now. When you are receiving from your data, of course, you normally credit. This is purchasing company. And we are saying here it's a data. Good. Sawa sawa. That's number 11. That's number 11. Okay. Now, because of our new students, listen, because of our new students, of course, I cannot finish. Today, I can't finish the entries in the books of the purchasing. Sorry, I can't finish the books of the selling and then discuss the books of the purchasing. No, we can't finish. Now, for the sake of the new students, let me mention something. Now I'm talking to the new students. I'm talking to the new students who could have joined this free class today. In case you wish to continue with our class, that means you wish to join our advanced financial reporting, then these are the timings. Listen, these are the timings. For advanced financial reporting, we have either early morning classes or evening classes. Our early morning classes starts from 5:30 in the morning to 7 in the morning, every Monday, Wednesday, and Friday, if you wish to join the early morning classes. If you are available in the evening, then the classes starts from 8 p.m. to 10 p.m. every Monday, Wednesday, and Saturday. Those are the timings for the evening class. Now listen, it's important for those who have joined us or those who are willing to join. For those who have joined, they already know. Listen now. In case you miss a class, let's assume you are on an evening class and on Saturday you have a function. Does it mean that you will miss the class for that Saturday? The answer is no. Or maybe you are in the early morning group and you wake up very late. Does it mean you will miss that class? The answer is no. You can still go back to the group where the link was posted and you can be able to watch the video of the class that you missed. So our system is such a way that in case you miss a class, you can go back to the group where the link was posted and you can be able to watch the video of the class that you missed. Or maybe I've taught you a class and you feel you need to listen to the class again. You can still go back to the group, click on the link that you want to listen to a class again, and you watch and you listen to it as many times as you want. If you are not available in the morning or available in the evening, there are some students who are telling me they work in shifts. So sometimes they are working late, sometimes they are working too early. You can also buy, or for whatever reason, you can also buy what we call the pre-recorded videos. You can also buy the pre-recorded videos for the whole syllabus, meaning you get them, all of them at once, and you watch them at your own free time, at your own pace. So if you want, you can also buy the pre-recorded videos. Currently, we are charging 4,000 shillings. We are charging 4,000 shillings for the whole syllabus or for the whole semester. Of course, if you join now, I'll still give you the videos of the classes that you have already missed. I'll still give you the videos of the classes that you have already missed. We also accept payments in installments. We also accept payments in installments. And so if you are interested in any of the classes, you can call me on 0722 65 8875. You can call me on 0722 65 8875. That's how you can reach me. You can either call or you text. We can talk more. Good. Now, some of you, again, have friends who are doing, some of you have friends who are doing financial reporting of the intermediate level. We are also having a financial reporting of the intermediate. The classes are every Tuesday, Thursday, and Friday. Again, from 8 p.m. to 10 p.m. Same system. In case they miss the class, they can be able to watch the video of the class they have missed. Alternatively, they can also buy what we call pre-recorded videos. Pre-recorded videos. We also have financial accounting for those who are doing foundation level, for some of your friends who are doing foundation level or of CPA, or they are doing financial accounting of the ATD 1 or 2. So if they are doing foundation level, which used to be called section 1, or they are doing financial accounting of ATD 1 and ATD 2, they also can call to get the videos or buy the pre-recorded videos for those subjects. Otherwise, for everyone who has not subscribed, to my YouTube channel, please subscribe to my YouTube channel. Please subscribe to the YouTube channel so that you can get notification whenever we send new videos to the group. You click on the notification button, that is the subscription button, and also the notification bell, so that anytime we post a new video to the YouTube, you may be notified. So please subscribe. Whether you are my student or you are a new student today, please subscribe. Okay, I think I've talked about everything that you need to know. So today being a free class, maybe we can stop there for now, so that next time I continue from there, from number 12. I continue from there, number 12. Today is Monday. On Wednesday, that's when we have our next class. So allow me to stop there for now, so that we pick it up from there next time. So for those who want to join, those are the timings. Please call me on 0722 658875. That is 75. We can talk. Okay? Okay, bye. So we have not talked today. Somebody say hi. We have not chatted. Somebody to say hi so that we can close the class for now. I have not asked you a question. I hope you are following. I have not asked you a question. I hope you are following. You chat on the live chat and say hi or good night. You say hi or good night. Yeah, okay, fine. I don't know whether there is anybody who is new. Anybody who is new and would want to join or give us a comment. Anybody who is new and want to give a comment can also chat. Maybe there is a new student who wants to say something, he can chat. If you are a new student and you want to chat, you can chat. Others have said hi, good night. Okay. So if that's okay, so maybe we can close the class now. Maybe we can close the class until Wednesday. For those who are new and they would wish to join, please call me on that number. Otherwise, good night. See you, everyone. Bye for now. Bye for now. Good night. Okay. Good night.